The IRS releases new inflation tax brackets. What does this mean for you? Greetings, fellow financial enthusiasts. Welcome back to the Elite Economizer, your ultimate guide to conquering the complexities of the financial world. Today, we're diving deep into the recently unveiled 2024 IRS tax brackets, meticulously adjusted to counter the ongoing inflation. It's imperative to understand the implications for your hard-earned money. But before we plunge into the intricate details, make sure you're subscribed to our channel. The journey to financial wisdom is best traveled together. The IRS has just dropped the bombshell: new tax brackets for 2024, a direct response to the relentless inflation. No speculation here, it's official, and these changes will come into effect for the upcoming tax year. Let's dissect the situation and explore whether the adjustments made by the IRS are fair to the average taxpayer. To illustrate the potential impact, let's dive into a simplified example. Imagine you earn $50,000 a year, and due to rampant inflation, your daily living expenses, food, rent, healthcare, you name it, double. In response, your income also doubles, reaching $100,000 a year. Now, the critical question surfaces: are you better off, worse off, or does everything magically balance out? Surprisingly, you find yourself worse off, and the culprit is the ominous specter of income taxes. As your income doubles, you inevitably ascend into a higher tax bracket, resulting in a significant increase in income taxes. This, my friends, is a direct consequence of inflation, prompting the IRS to make crucial adjustments to tax brackets and rates to mitigate the impact. In the United States, our tax system operates under a progressive model, where the more taxable income you have, the higher your overall tax rate. Let's dive into the nitty-gritty of tax brackets. The first $1,600 you earn is taxed at a 10% rate. Once your taxable income surpasses $11,600, congratulations, you've just entered the 12% tax bracket. However, it's paramount to grasp that only the income exceeding the threshold faces taxation at a higher rate. This progressive system becomes a bit of a financial jigsaw puzzle when combating inflation. As you earn more, your overall tax rates ascend, painting a complex picture of financial management. If these insights are proving invaluable to you, now would be the perfect time to hit that subscribe button. Stay updated on all things financial with the Elite Economizer. The moment of truth: the IRS has officially declared a 5.4% increase across all tax brackets for the year 2024. But does this adjustment pass muster? Let's engage in a side-by-side comparison of figures from 2023 to 2024. In 2023, the first $111,000 was taxed at a 10% rate. Thanks to the 5.4% increase, in 2024, this threshold has gracefully ascended to $1,600. The overarching goal of expanding all tax brackets by 5.4% is to ensure that a more substantial chunk of your income is taxed at the lower rates. However, the swift acceleration of tax rates, especially at the $47,500 mark, raises legitimate concerns about the true fairness of the system. The IRS appears hesitant, perhaps mindful of the potential revenue loss. Is this reluctance fair to the hardworking individuals navigating the unpredictable seas of the stock market? A classic example of the IRS's reluctance to adjust for inflation lies in the state and local tax, SALT, deductions. Capped at $10,000, this deduction fails to keep pace with the rising tide of state income taxes, locality taxes, and property taxes. For many Americans, especially those residing in high-tax states, this cap feels like a financial straitjacket. Shouldn't this deduction, too, bear the weight of an inflationary adjustment, offering relief to those burdened by ever-increasing tax obligations? Before we delve further into the intricacies of the tax code, a friendly reminder to hit that subscribe button. Your support fuels our mission to decode the complexities of the financial world. The net investment income tax, a silent player in the tax game, casts a shadow over those earning dividends, interest income, and capital gains. Fixed at 3.8%, this tax fails to acknowledge the relentless march of inflation. As investment returns struggle to outpace rising living costs, more Americans find themselves ensnared in this additional tax burden. Is it fair to impose an unyielding tax percentage without considering the financial challenges posed by an inflationary environment? Amidst the labyrinth of tax intricacies, a simple call echoes, an equitable adjustment for all. The IRS's focus on adjusting tax brackets offers a glimpse into the potential for fairness. However, the selective nature of these adjustments leaves many aspects of the tax code untouched. A holistic approach demands a reevaluation of thresholds, deductions, and tax percentages to truly mirror the economic realities faced by the American taxpayer. It's time to shed light on a pervasive oversight: the non-adjustment of Social Security benefits for inflation. With over 60 million recipients, this oversight exposes a flaw in the system. Originally tax-free, Social Security benefits fell victim to taxation in the 1980s. While the government sought to address the impending insolvency, it failed to keep pace with inflation. The $25,000 threshold for singles and $32,000 for couples, set more than 4 decades ago, remains frozen. As inflation erodes purchasing power, more Social Security recipients find themselves pulled into the taxable net. Is this oversight a deliberate tactic, or an unintended consequence of bureaucratic inertia? Our exploration of the tax code wouldn't be complete without examining broader canvases like the standard deduction and tax-free gifts. The 5.4% adjustment graces these elements, offering a glimmer of hope for those seeking relief. The 401k and IRA contribution limits also witness modest increases. However, the unchanged catch-up contributions may leave some questioning the true commitment to aiding those approaching retirement age. Let's broaden our perspective to the overarching economic policies that influence our financial landscape. In recent years, the Federal Reserve's monetary policies have played a significant role. Quantitative easing, low interest rates, and unprecedented interventions in financial markets have become the norm. As we navigate these economic waters, it's essential to consider how these policies intersect with our everyday financial realities. Are these measures fostering stability, or do they introduce complexities that trickle down to affect the average taxpayer? Amidst the evolving economic landscape, the real estate market remains a crucial player. Homeownership, a cornerstone of the American dream, faces the impact of inflation and economic policies. The rapid surge in home prices, often exceeding 30% to 40% since the onset of the pandemic, prompts reflection. How do these market dynamics influence the financial decisions of individuals aspiring to own a home? Are these price hikes sustainable, or do they signal a broader economic challenge that necessitates attention? Before we delve into the intricate interplay of economic policies and real estate, take a moment to subscribe to the Elite Economizer. Your subscription ensures you stay informed and empowered in the realm of personal finance. Returning to the realm of personal finance, let's explore the implications of retirement contributions. While the 401k and IRA contribution limits see marginal increases, it's worth contemplating their role in long-term financial planning. As the cost of living escalates, how does one strike the right balance between contributing to retirement accounts and managing day-to-day expenses? Navigating this balancing act is crucial for those charting a course toward financial security in their later years. As we dissect the impact of inflation, it's vital to acknowledge its disproportionate effects on various income groups. Inflation doesn't discriminate. It affects everyone. However, the degree of impact varies based on income levels. For those with limited financial resources, the strain of rising costs on essential goods and services is particularly burdensome. How can we, as a society, address these disparities and work towards a more inclusive financial landscape? In the quest for financial empowerment, the role of government accountability cannot be overstated. Awareness is the first step towards holding our elected officials accountable for economic policies and tax regulations. Engaging in financial literacy initiatives and understanding the broader economic landscape empowers citizens to actively participate in shaping policies that impact their financial well-being. How can we bridge the gap between government decisions and citizen understanding to foster a more transparent and equitable financial system? Advocacy and financial education emerge as powerful tools in navigating the complexities of our financial system. Individuals equipped with knowledge become advocates for change, pushing for fair tax policies, transparent economic decisions, and increased financial literacy. How can we collectively contribute to a society where financial education is prioritized? enabling individuals to make informed decisions that align with their long-term financial goals. In our quest to demystify the IRS's 2024 tax adjustments, we've traversed the intricate landscape of tax brackets, economic policies, and their repercussions on everyday financial realities. As we conclude this exploration, the call for fairness, transparency, and financial empowerment echoes louder than ever. Your engagement with the Elite Economizer is a testament to your commitment to understanding and mastering the art of personal finance. If you found this extended exploration enlightening, consider sharing it with others who are on their journey to financial mastery. Hit the like button, share your thoughts in the comments, and, most importantly, subscribe to the Elite Economizer for a continuous stream of insights, strategies, and discussions aimed at elevating your financial acumen. Together, let's navigate the ever-evolving financial landscape with knowledge, resilience, and a collective commitment to financial empowerment. Until our next exploration, stay financially savvy,